We're all here today because, among other things that obviously have us concerned, we're nervous about the markets. So I'd like to spend the next 25 minutes together giving you some key insights, some concrete questions you can ask yourself, and some practical action steps you can be taking to increase your financial certainty. Because whether sitting in front of your TV or computer or scrolling through your phone, uncertainty seems to rule the day right now. Monday, March 9th, marked the beginning of the stock market crash of 2020, with the history's largest point plunge in the Dow Jones to date. That day was followed by two more huge drops on March 12th and 16th. And so far, we've seen the three worst single-day point drops in U.S. history. Over just a few weeks, markets have dropped anywhere from 25 to 30%. And the question everyone is asking is, should I stay or should I go? In other words, should I ride this thing out, as many advisors have traditionally recommended, or do I stand to lose a ton more, waiting for this thing to bounce back? If that's you, if you're wondering what to do, I want to let you know that at the conclusion of this session, you'll have the opportunity to set up a 15-minute phone consultation or virtual meeting with our firm, and I highly encourage you to do that. We've been flooded with individuals calling for advice over the past several weeks, and that's what we're here to do. We'd be happy to assess your situation, talk through your options with you, and help you get a plan in place to protect yourself, no matter what happens in the market. So be sure to take advantage of that opportunity as we wrap up today. It's really no wonder you're concerned about the market. If you ask 5 people right now what the market's going to do, you'd get 5 different answers because the truth is no one really knows what's going to happen. And frankly, anyone telling you they can predict things should seem eerily suspicious right now. We're in uncharted waters here. There's never been a global pandemic impacting global markets as we're experiencing today, and no one can predict where things will go from here. With so much information flying at you at once, how do you even make sense of it all? And knowing that no one has a crystal ball, what indicators should you be looking at right now to help you inform your decisions? Well, there actually are some key indicators we can keep in front of us for perspective. Let's take a look. Here are 5 key factors to keep in mind as you consider your financial future and the level of risk you're willing to take. First, the speed with which the market has dropped. Second, the potential for the market to drop even further. Third, the skyrocketing unemployment numbers we continue to hear. Fourth, the overall impact this pandemic is having on several key industries and the economy overall. And finally, the rate at which the virus continues to spread. Let's take a look at each of these individually. The first variable we can look at is the speed with which the markets have recently declined. It only took the S&P 500 22 trading days to fall 30% from its record high reached on February 19th, making it the fastest drop of this magnitude in history. If we look at this graphic showing data from Bank of America Securities, we can see that the second, third, and fourth quickest drops of 30% on Wall Street all occurred during the Great Depression era in 1934, 31, and 29 respectively. In other words, nothing like this has ever happened, but the closest thing to it was nearly a century ago, during the worst economic downturn in our country's history. When the market crashed in October of 1929, by July of 1932, the Dow Jones was down 89% from its previous record high. So as you think about your retirement savings, it becomes critical to consider a second factor. How much further could markets continue to drop? Having seen a roughly 30% drop so far, and knowing we don't know when the virus will be controlled, it's fair to at least acknowledge that the market could still drop considerably more. In fact, in a March 23rd article in Forbes Online, senior contributor Chuck Jones indicated it was very plausible that markets could drop another 20 to 40%. Again, none of us know what the market's going to do, but hypothetically speaking, if it did drop another 20%, bringing the total decline to 50%, well, let's take a look at what it would take to recover. One of the things many people misunderstand is the amount of gain required to recover from a loss. Mathematically speaking, losses hurt more than gains help. As an example, if you had $1 million in the market and lost 50%, you'd be down to $500,000, right? And many people simply think, well, if I had a 50% loss, I obviously need a 50% gain and I'll be right back to where I started. Unfortunately, that's not how the math works out. And this is one of the most commonly misunderstood things about the market. As you see here, if you took the $500,000 you had left after a 50% loss and you experienced a 50% gain, you'd actually be back to $750,000, still well short of where you began. In reality, in order to recover from a 50% loss, you actually need a 100% gain. And how likely is that to happen in the market? Better yet, how long might that take? Well, during the Great Depression, when the S&P dropped 89%, it took the Dow over 25 years to return to its previous high. So while we don't mean to be alarmists, if you were to experience anything even remotely similar, you really have to ask yourself, do I have the time necessary to even see the markets climb back up? And for someone 60 to 70 years old, they simply may not have that many years. Several of you may recognize this man. He's Warren Buffett, one of the most famous investors alive and currently the fourth wealthiest individual in the world. Known for his market savvy, Buffett has amassed a net worth of $70.5 billion. So what does he have to say about incurring market losses? Well, he's long been quoted as having two primary investment rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Why does he say that? Because just as we've seen, losses hurt more than gains help, and it takes a lot to recover from a significant loss. Because just as we've seen, losses hurt more than gains help, and it takes a lot to recover from a significant loss. Buffett's always understood that if you want to make money, you start by not losing what you already have. He also recently said it's insane to risk what you have for something you don't need. In other words, the fourth wealthiest man on the planet isn't a big fan of taking on excess risk, particularly when it's not required to reach your end goal. So what does that really mean to you? It means if you can live the life you've desired in retirement right now, without having to take significant market risk to hopefully accumulate more, you likely should. For many who've had a good run in the market over the past decade, if staying in right now to hopefully pick up some gains if the market recovers would be nice, but not necessary, the added risk just doesn't make much sense. So having looked at the speed of the market dropping and how much further it could potentially go, let's look at a third factor to consider. The third indicator is the alarming rate of unemployment being caused by the virtual shutdown of our nation. A record-breaking 3.3 million Americans applied for it the week ending March 21st. The previous record in this country was just under 700,000 claims, filed in a single week back in October of 1982. That means the week ending March 21st was nearly 5 times higher than the previous record. Forecasts for unemployment in April alone range from 500,000 to 5 million new Americans without jobs. In fact, weekly unemployment claim numbers are climbing so rapidly, the White House has recently asked state officials to delay releasing precise counts. Economists at the Federal Reserve project total unemployment could reach 32.1%, totaling 47 million Americans. 47 million people. That's roughly equivalent to all the residents in New York, Florida, and Colorado combined. So unemployment doesn't look good. Well, what about the global economy? Well, our fourth variable here is the impact this outbreak is having on major industries and the economy worldwide. The retail industry, which is normally responsible for contributing about $2.6 trillion or 25% to the annual GDP, has nearly ground to a halt with stores closing. The hospitality industry is losing roughly $1.4 billion a week with travel restrictions now in place globally. And according to Reuters, global airlines estimate their 2020 revenue losses at over $250 billion as planes sit idly at gates everywhere. All told, estimates suggest the coronavirus could easily cost the global economy over $2.7 trillion. So what does all of that really mean? Well, first, it virtually guarantees continued market volatility for months to come. And second, it means additional economic stimulus will likely be required by the government, which could lead to higher taxes in the future as we all have to help repay the funds used. But all of this could obviously be greatly improved if we just stem the tide on the coronavirus outbreak itself, right? So how are we doing there? Well, let's take a look at that. The U.S. now has the highest number of COVID-19 cases in the world, quickly surpassing China and Italy. There are currently over 140,000 Americans suffering from it, and those numbers climb every day. And those numbers, by many accounts, are surely very conservative, as people in many states struggle to even be checked for it due to the shortfall in tests. Epidemiologists at the University of Washington predict that if gaps in healthcare resources aren't filled, more than 80,000 Americans could die by July. To put that in perspective, look at the counts in the U.S. from recent outbreaks such as SARS or H1N1. SARS claimed 774 lives worldwide, but none in our country. H1N1 in 2009 killed 12,469 in the U.S., so the death toll in just the next few months is anticipated to be 6.5 times worse. So with all these variables considered and so much feeling completely unpredictable right now, what can we predict? What can we be sure of as it relates to your financial future? Well, the reality is the only thing that's relatively certain right now is uncertainty. And while we'd all like to know when this pandemic will end and when everything will return to normal, the truth is we likely need to be planning for the worst and hoping for the best. So what does that mean tactically to you right now about your retirement savings? Well, there are obviously hundreds of things you could be doing with your money in this environment. But for the sake of this discussion, let's just focus on 3. The first option you have with any money currently invested in the market is to simply leave it alone. Just about everybody's heard the phrase ride it out or been told to just weather the storm. And for decades, many advisors have been advising their clients not to time the market, but to leave money in for the long haul. The problem, as we've discussed, is that there's no current assurance that A, we're at the bottom of this present decline, or that B, we're going to see any noteworthy recovery anytime soon. And again, if the market was to drop another 20 to 40% on top of the 30% it's already fallen, you could find yourself up to 60% down from where you began. Had you had an even $1 million invested for retirement on March 8th of this year, that would leave you with just $400,000. Many people just aren't interested in that kind of risk. Option number 2 is simply sell off or cash out and hang on to what you have left. For many people who've been invested over the past decade, you're still sitting on some solid gains over that stretch, and you could decide you simply want to go to cash and sit completely on the sidelines while this entire ordeal sorts itself out. While you'd obviously be earning nothing on your money, you might subscribe to the old saying that a bird in the hand is worth 2 in the bush. However, knowing at some point in the future, hopefully sooner than later, this outbreak will end and the economy will start to recover, do you really want to miss out on all the potential gains of riding the market back up? Many people aren't interested in that plan either. So if staying in the market doesn't make sense to you, but going completely to cash and earning nothing when the market recovers has no appeal, then what are you supposed to do? Well, everyone's situation is unique, and it calls for custom-tailored solutions. But I can tell you one benefit many people are looking for, and that's found in option number 3. Let's take a look. A powerful third option, for those who don't want to ride things out and don't just want to go to cash, might be the use of a fixed index annuity, or FIA. FIAs are retirement savings vehicles that provide complete principal protection, meaning the money you put in them can never be lost to market downturns. And they also give you the opportunity for growth. Just like a traditional fixed annuity, an FIA is an insurance product often intended for retirement income purposes. However, unlike traditional fixed annuities, a fixed index annuity gets its name because it ties its annual growth to a market index, such as the NASDAQ or S&P 500. Rather than offering a set or fixed interest rate, an FIA's interest credits follow the performance of the market index to which it's tied. Because principal is protected in an FIA, should that market index go down in a given year, your account balance remains flat or unscathed for that year, and you simply receive 0 interest. Should that market index rise, you get to participate in a portion of those earnings. Now, you can't have your cake and eat it too, so an FIA will not provide all the earnings of a rising market. Your earnings will be capped at a certain level and also be subject to spreads and early withdrawal charges, but that's the simple trade-off for knowing that the money you put into an FIA will never be at risk again. It might help you to understand an FIA by thinking of it like this. You sit down at a blackjack table in a casino and the dealer says, "All right, here's the deal at my table. If you lose a hand, I just shuffle the deck and re-deal. No chips lost. But if you win a hand, I keep 50% of the take." If a dealer told you that, how long would you sit at that table? Who wouldn't sit there all day, right? Because while you're not promised the moon, remember the dealer's keeping half of your earnings. You're promised to never lose a dime. In other words, it's all upside possibility with no downside risk. This is very much like the premise of an FIA, and let me tell you right now, people with money in fixed index annuities are most likely doing cartwheels. Because while their neighbors and coworkers or family members might be down 30% in the market, their account balances are simply remaining flat. They're not losing a cent. Simply ask yourself this question: which would I rather miss out on? Capturing every cent of an eventual market recovery when this pandemic ends, or potentially losing another 20 to 40%? If you'd be okay missing out on some of the future recovery, but you can't stand the thought of more loss, it's likely time we hop on the phone. None of us knows what lays ahead, but the chief investment officer of Guggenheim Investments just said in his recent CIO Outlook, "I'm not betting on a global depression, but I am saying that for the first time in the post-war era, we're really getting too close for comfort." When the CIO of a global investment firm managing over $270 billion says something like this, you want to listen. The road ahead is likely to be bumpy, and while tons of things right now are out of your control, your financial future actually isn't one of them. That, fortunately, is something we can help with. And in the midst of these crazy times, it's important that you not just have a portfolio, but that you have a plan. And we can help. Getting started is as simple as can be. While businesses all over the country may be shut down, ours is 100% open virtually. And a visit with us is as simple as an initial 15-minute phone call or a virtual meeting with our team. You'll just click on the link to choose your desired time, and at that time, we can either contact you by phone or connect for a virtual meeting using your home computer. It's that easy. Oh, and here's what that visit won't be. It won't be a member of our team sitting on the other end of the line pitching you something or telling you to grab a checkbook. Instead, it will be us getting to know you, asking some key questions, and listening to your concerns. We can conduct a risk exposure analysis, showing you exactly how much of your assets are currently exposed to further risk. And if you're interested, we can make recommendations as to which next steps would benefit you most. It all starts with simply selecting a time to connect. I want to leave you with one more quote from our friend Warren Buffett. He's famous for having said, when it comes to the market, you never know who's swimming naked until the tide goes out. In other words, many people just don't realize how exposed they are on Wall Street until the market crashes. The good news is you can do something about any further losses starting right now. Click the link below to choose a time for us to connect. You'll immediately receive a confirmation email letting you know we're all set. Then, in the meantime, grab a cup of coffee, take a deep breath, enjoy the little things around you. It's going to be okay. And we look forward to talking to you soon.